Hi, my name is Gokul Narayan, and I have with me Dr. Aditya Nain. I am a novice at finance, but I do hold a degree in intellectual property and information technology, which is theoretically absolutely useless for the purpose of this channel. But thankfully for our audience and me, we've got Aditya with us, who is an expert in finance. And therefore, to clarify and demystify certain problems that I have traditionally faced, and hopefully you're facing the same issues that I have, we have him on board. Today, I wanted to specifically talk about a basic misunderstanding that I had in the investment market, that of the difference between equity and debt. I had my own warped versions of it, but I'm not going to confuse you with those. I'm just straight away going to ask Aditya to step in over here and ask him to explain to us the difference between equity and debt, and why traditionally debt is supposed to be a more understood to be a more stable form of investment to us. Aditya, thank you for joining us, and please
Thanks.
take over.
Thanks, Gokul. Okay, so we just want to talk about the difference, in a simple manner between investing in equity versus investing in debt. So think of it this way. Debt is like a loan,
Okay.
but typically when you think of a loan, you think of going to a bank and a bank loaning you money, that is giving you money, and then you
Correct.
have to promise to pay it back.
Correct.
That's because you are in need of money and the bank has it. Right? The bank says, I'll give it to you as long as you give me X% interest year on year, etc. Now, a bond, on the other hand, if we just flip that, now what if a bank came to you and said, I have need for some money, I need capital for my business, and I'm willing to take your money, that means, mine and yours, and give you a certain stable rate of interest in exchange, and I'll promise to give it back to you.
Okay.
Now, that's a bond. So a bank would then be issuing a bond. We as investors would get to buy that bond, right? Which means that we become creditors to the bank, and the bank is our debtor. So the bank is in debt to us to pay us interest on the bonds that we have bought.
Okay.
Right?
Okay. That makes sense.
So we give the bank money. The bank issues a piece of paper, that means a debt piece of paper, to us, and says that they're going to promise to pay us, and then they keep paying us that money year on year based on the yearly interest rate. Now, this can be the
Okay.
same thing if a government comes to you and says, look, we need money, are you going to give it to us? So you and I as investors can tell the government, yes, here's money. The government issues bonds, right? So the government is promising to pay us, so we are loaning money to the government in the same way that we
Okay.
loaned it to a bank.
Okay. Okay. So over here, Aditya, just to clarify, over here, do these financial institutions, governments, banks, uh, uh, do they fall into the same category as debtors as we would if we were asking for a loan? So, for example, what I mean by that question is, if we default on the loan, CIBIL brings our credit rating down and things like that. Do they have a similar kind of a setup? And can they be taken to court if they don't end up paying you back the bond?
Yeah, so creditworthiness applies both to individuals and to institutions. So if you and I go and apply for a loan, as you said, they'll check our credit score, which is based on our payments history and things of that sort. Um,
Correct.
on the other hand, it's not exactly the same, but governments and companies that issue bonds or want to issue bonds also have some accountability in terms of the creditworthiness. And usually there are credit rating agencies. So you may have heard of Moody's, for instance, which is a large global
Correct.
credit
Correct.
credit rating agency. Crisil, Moody's, Standard and Poor's, or S&Ps, which are credit rating agencies which will rate institutions. An institution could be a government institution, it could be a private institution,
Okay.
and the investment community at large, the guys with the money to buy bonds, it could be institutions or individuals, can rely on, or often do rely on, the credit ratings given to these institutions by, let's say, Moody's. So if Moody's rates, a certain government debt AAA, or which is a high rating, let's say a AAA to some government debt, then investors are going to feel good about the credit worthiness. That means the ability of that government to honor its debt payment.
So just like in an individual borrower, however good your CIBIL rating is, the person giving you a loan is still taking a chance that you will still continue repaying it. So, okay, so that makes a lot of sense, Aditya. Now, could you throw a little bit of light on the equity part of it and how equity functions differently from debt?
All right. So Gokul, while is in debt, somebody's promising to pay you money in the form of interest. In equity, nobody's promising you anything. So what you are
Okay, that's
doing,
scary.
you're buying a part of a company. At the most basic level, buying shares in a
Okay,
company is buying a part of a company. As an example,
okay,
if you buy 100 shares of HDFC, then you're buying
mhm,
100 shares worth of ownership of HDFC, right?
okay,
So, which doesn't mean much in terms of HDFC and its operations as a company. Like you're not going to be able to
yeah,
go and have any say, of course, in the functioning of the company, but you get the ability to participate in the stock rise, hopefully rise of HDFC. But if the HDFC stock falls, then the value of your investment is going to fall. So when you buy a stock, you're basically just buying a share within a company. Now,
so therefore, you try and take a company which you think in the future, which is currently doing well, or at least in the future will be doing better than it is doing today.
yeah,
And okay,
and you earn in two different ways if you buy shares of a company or equity.
okay,
One is through the capital appreciation or the increase in the stock price that we just spoke about, and the second is through dividends. Now, a dividend is basically a part of the company's earnings that it
mhm,
decides to distribute to shareholders in proportion to the number of shares that they have. So, if you had 1,000 HDFC shares and if I had 100, you would get more of a dividend and I would get less, but the per share dividend amount would be the same. So let's say if HDFC said we're going to give 1 rupee per share to all shareholders, you'd get 1,000 rupees, I'd get 100 rupees of dividend.
okay,
But there's no
okay.
guarantee that either of us are going to get this dividend, and there's no guarantee that the company is going to pay out dividends. So
So there is no requirement on the company, even if it posts profit for a particular year, that it should declare dividend. It might decide that instead of paying dividend, we'll invest it back into the company itself. That
yeah,
could be a possible take.
yeah. So the company does have that discretion. It's not like a bond where they're legally obliged to pay something. But some companies, let's say companies that have a strong dividend track record, they will want to keep paying dividends, because if let's say if I buy a company in anticipation of being paid dividends, and if they don't pay it, then I'm going to feel there's something wrong with the company, and a lot of other people are going to feel that, and then it's the people start selling shares in that company. But yeah, so some companies are known for higher dividend payments, and some companies are known for not having much dividend payments.
So, although, like you pointed out, it's not a mandatory requirement. I mean, it is an
Yeah,
option that the company has. But if
correct.
their track record is that they give out dividend, then the likelihood is that they'll continue giving out the dividend.
Yes.
Therefore, since uh, a debt
Mhm,
is in the form of a loan taken by an institution,
mhm.
traditionally it is a much safer instrument, but therefore has a very fixed rate of interest which is guaranteed to you, and
Yes.
therefore grows substantially slower in terms of wealth generation than an equity does, which is basically then directly just linked to the performance of the company. If the company does really well, it could go up as the company does well in a particular financial year. And
Yes.
if it doesn't do too well, then it will proportionately grow lesser.
Correct.
But the possibility of high growth in an equity is much more, but so is the risk that it does not grow or it falls also.
Correct. Absolutely. All right. So Gokul, there are various ways in which you can access debt or bonds. Um, and we won't get into that now. We'll do that in another video. So, for instance, you can buy a bond or a debt mutual fund, for instance. Um,
Mhm.
and there are some things that investors need to know also. Then what the implications are of holding it in different ways. And we'll keep that for another video for sure.
Correct. So just like you can invest in equity either directly by trading at a stock exchange, or you can do it through a mutual fund. Similarly, you can either hold a debt directly in the form of a bond, or you could put it into a mutual fund relating to bonds, and their implications would be different.
Yes.
Okay, great. All right, guys, thank you so much for joining, and thanks, Aditya, so much for clarifying this. It's a lot more clear in my head now. And in case, as usual, if you have any questions or queries, please feel free to leave us a comment, and we'll try our best to respond to all of you. Thank you so much, guys, for joining us.
Thanks a lot, everybody. And of course, please like, share, and subscribe if you did, in fact, like the video. Thanks a lot.
Yeah, that's very important.